Hello and welcome to this next topic of AS11. This is a standard on foreign exchange. It is a fairly tricky standard and there are three parts mainly on this standard, covering how will you account for a foreign currency transaction. Second, what if you have a foreign subsidiary or a foreign branch? So how will you convert the accounts of the foreign branch into your own currency? And third is forward contracts. Now before we go into the detailing over here, to what type of transactions will AS11 apply? First of all, let us say you are an Indian company, your reporting currency is the Indian rupees. Usually you buy goods in India, you sell goods in India, you give loans, take loans, do everything in Indian currency, and as a result all your transactions are denominated in rupees, and while passing the entries in your books of accounts you record them in rupees. However, one of you might actually buy goods from the US and have to pay the US dollars, or you might sell goods to Europe and get money in euros, in which case the invoice is denominated in euros, and hence typically for sales we pass the entry debtor account debit to sales. But the problem is, if these sales are denominated in euros, I cannot record a part of my accounts in rupees and a part of my accounts in euros, and as a result I need to convert all of the foreign currency transactions into a single currency. Now what is that currency? That is usually called as a home currency. That is a currency of the primary economic environment in which you operate. So if you are the Indian customer, then the primary economic environment for you will be the Indian environment. If you are an Indian company, in which case you will record everything in rupees. So if your transactions are already in rupees, we don't need to convert anything. However, if your transactions are in some other currency, then you will have to convert them into the rupee currency, and hence at what rate should you convert these transactions? That is, at what rate should you convert these incomes and expenses? And secondly, if these items are still outstanding as on the balance sheet date, at what rate will you record these assets and liabilities, let us say in the balance sheet date, is the first part where you have to figure out the different rates to be used. So what are those rates? A few key terms over here is, first there will be something called as a historic rate. Historic rate would refer to the rate prevailing as on the date of the transaction. So whenever the transaction happens, on that rate, whatever is the rate is called as a historic rate. Second is the closing rate. Closing rate refers to the rate which is there on the balance sheet date. So if you are preparing the balance sheet on 31st March 25, the closing rate would be the rate on 31st March 25. That is the closing rate appearing on the balance sheet. Usually opening rate is the rate at the start of the year, and then there is another term called as the average rate. Average rate is usually opening plus closing divided by 2 if nothing else is given. However, if a separate average rate is given, you will take that because you can take the average on a monthly, daily, or even on a weekly basis for the entire year. So over here these are the rates. Now before you go into the foreign currency conversion principles, AS11 tells you that the selection of rates, at least on the balance sheet date, depends on whether the assets or liabilities are monetary items or non-monetary items. Now what are monetary items? Monetary items refers to those items which can be converted into a fixed or a determinable amount of money. Like debtors, if they have 22,222, they will give you exactly that, not a penny more, not a penny less. That is a monetary item. Or creditors, you have to pay exactly a determinable amount of money. For that matter, even bank balances, cash or bank balances, or even loans taken or loans given, or investment in debentures, all of these will give you a fixed or a determinable money value, and hence these are monetary items. On the other hand, you look at non-monetary items. Non-monetary items are those items which will give you some benefits if they are assets, or which will have an obligation if they are liabilities, but you can't quantify or determine that in money value terms. Like when you invest in equity shares, you will get some dividends, you will get some capital appreciation, but you cannot quantify that in money value terms. Or if you invest in a land, you might get some rentals, you might kind of get some capital appreciation, but you can't quantify that on a fixed or a determinable monetary value. So don't have that misimpression that non-monetary items are those items which don't give benefits. No, non-monetary items which are assets can also give you benefits. However, you cannot quantify them, determine a fixed or a determinable amount of monetary benefits, and hence they are called as non-monetary items. So when we look at monetary items, these refers to assets or liabilities which are received or paid in contractually fixed or determinable amounts. A few examples. And the non-monetary items do not necessarily give us a contractually fixed or determinable amount. That is what we call as a non-monetary item. Now, at what rate should you record the transactions? Let us say we take a very simple example of you exporting goods of $1,000 on 1st of January 2025 and a credit period, let us say, of 4 months. In which case you will record the entry debtor account debit to sales. This will be recorded on 1st January 2015 at the exchange rate prevailing as on the date of the transaction. So on the date of transaction, if the rate is 80 rupees per dollar, debtor account debit to sales will be recorded at 80,000 rupees. Generally, we take the rate on the date of the transaction. However, if the rate on the date of transaction is not available or an average rate is given, we can always take the average rate as long as it reasonably approximates with the rate on the date of transaction, there is not much volatility. So, but if from an exam perspective, you will be generally given the rate on the date of the transaction. Now, P&L that you prepare is for the year, and hence when you prepare the P&L for the year 24-25, sales have happened during the year and you must have recorded the sales at 80,000 rupees. However, in the balance sheet, the debtors are still appearing. Now, debtors are monetary items because they give you a contractually fixed or determinable money value, and hence on 31st March, your debtors are at $1,000, but in the balance sheet, you must have recorded them at 80,000 rupees. That is the entry that was passed. But the problem is balance sheet is prepared as on date. P&L may be for the year, balance sheet is as on date, and hence on the balance sheet date, you will convert these monetary items at the closing rate. So if the closing rate is 85, you will convert $1,000 into 85, and hence 85,000 will be the debtors. But they were at 80,000, and hence debtors will be debited by 5,000. What will you credit? Forex gain. And where will this gain go? In the P&L. There can be a gain or there can be a loss. It will be taken to the profit and loss account. So over here, at every subsequent balance sheet date for monetary items, you will remeasure the monetary items at the closing rate, and any foreign exchange gain or even loss will be taken to the profit and loss account. So your entry will be debtors account debit to forex gain in the P&L account of 5,000 rupees. Now it is possible that on 30th April, when you actually receive money, the rate moves from 85 to let us say 83, in which case you have recorded debtors in your books at 85,000, and now you are going to get $1,000 from your debtors, which you sit and convert on 30th April. You will get only 83,000 rupees. So your journal entry will be bank account debit 83,000. To debtors 85,000, and 2,000 will be taken as forex loss in the profit and loss account. So whether the gains are realized or whether the gains are unrealized, you will take it into the profit and loss account for monetary items. But for non-monetary items, you will record these non-monetary items, which are usually PP, inventory, intangibles. All of these will usually be recorded using the cost model, that is cost less depreciation. Standard says that non-monetary items will be recorded historical cost. Like for example, you can buy land of $1,000 on 1st January 25 on cash basis. Your entry will be land account debit. Let's say 80,000 rupees to bank 80,000 rupees. That is $1,000 into rupees 80. Now come 31st March, the land is still appearing at 80,000 rupees, but the closing rate is 85. Should you remeasure it to 85? AS11 says no. Why? Because it is a non-monetary item. The logic over here is, for a non-monetary item, the amount appearing in the balance sheet should be $1,000, let's say, into 85, and hence you might book a 5,000 gain if you convert them into closing rate. AS11 says that for non-monetary items on 31st March, no one is telling you that you will necessarily get $1,000. You might get more, you might get less, and as a result, if $1,000 itself is not certain, then how can the gain or loss based on $1,000 be certain? For monetary items, it is sure that you will receive 1,000 or you might pay 1,000 as a case. Maybe for non-monetary, that is not sure, and hence accounting principles say that if you can't measure something reliably, rather than measuring it in a slightly incorrect way, you don't record the forex gain or loss at all, and hence you will keep the land at 80,000 only. However, sometimes even non-monetary items will have to be remeasured. Maybe you are following the revaluation model for land, or maybe inventory is cost or NRV, whichever is lower, and NRV in fact is lower. In such cases, AS11 says that if the land was purchased in 2015 at $1,000, you kept it at $1,000 only. In 2020, you revalued it and took it, let us say, to $1,500. Now in your balance sheet, your land is shown at $1,500, which is on 1st January 2020, then the rate should also be on the date when the fair value is determined, that is 1st January 2020. So the general principle over here is, if you enter into a foreign currency transaction, purchase, sales, whatever it is, you will record it at the exchange rate prevailing as on the date of the transaction. At every subsequent balance sheet date, assets and liabilities which are monetary in nature will be remeasured to the closing rate, and the difference, if any, will go to the foreign exchange gain or loss in the P&L. And if they are non-monetary items which are kept at historical cost, you will keep those non-monetary items at historical cost only by taking the historical rate. However, if the non-monetary items are remeasured at fair value, then you will take the rate on the date when fair value was determined. Okay. In no case will you readjust the sales or purchases earlier recorded, because when you sold the goods, you said sales was 80,000. Now later you might get 85,000 or 83,000. That extra 5 or 3,000 is not due to you selling a higher quality good or anything. That is because of foreign exchange changes, and the gain or loss will go to the foreign exchange gain or loss in the P&L. It will not impact your sales. So over here, if you go to see, initial recognition will be the spot rate on the date of the transaction. Subsequent recognition for non-monetary items at cost will usually be at historical rate. Monetary items will be at closing rate. If the non-monetary items are to be shown at fair value, then you take the rate on the date when the fair value is determined. Now, these are the general principle. Any gain or loss will be shown as forex gain or loss to be shown in the profit and loss account. And there is one special case for which institute sometimes might ask you a question. This is on long term. Remember, long term monetary items, that is like a loan. So when you take long term loans, long-term loans are still monetary items. It may be a 10-year loan, but I exactly know that these are the amounts I have to pay for interest and principal over the 10-year period. So the amount is fixed or determinable in monetary value terms, and hence long-term loans are monetary items in nature. And as a result, if there is any foreign exchange gain or loss, like for example, you took a loan of $100 million when the rate was rupees 80 per dollar. Now by the end of the year, the loan is a 10-year loan, the rate moves to rupees 85 per dollar, and hence you will have a foreign exchange loss. Why? You recorded a liability of $100 into 80, that is equal to 8,000 rupees. Now you believe that the liability will be $100 into 85, that is 8,500 rupees, and hence you have to pay 500 more for this monetary item. So liability, that is loan, will be credited. What should be debited? Well, ideally forex loss in the P&L should be debited. So as per the default of AS 11, if nothing is given, foreign exchange gain or loss on the loan will be taken to the profit and loss account. However, AS 11 introduced earlier an option called as para 46 or 46A of AS 11, where they said that only and only for long-term loans, in case you want, you can decide not to take this forex loss of 100 in the PNL. Instead, depending on the type of the loan, like if it is a general purpose loan, then you can capitalize this into a separate account called as foreign currency monetary item translation difference account, or FCMITDA. And that balance of 500 will be amortized to the PNL over the loan tenure. What is the logic behind this? Well, loans are usually long term in nature, and hence your creditors, debtors are usually short term, and hence the gain or loss will quickly materialize. Now these loans are long term in nature. There may be a loss of 80 and 85, but that is not going to materialize immediately. It will eventually materialize when you repay the loan, which will take 10 or 15 years, and hence AS 11 says that okay, over here we will give you a choice to spread this over rather than recording it immediately, but that will have to be applied uniformly whether there is a gain or loss. Okay, this is for a general purpose loan, that instead of taking the forex gain or loss on the PNL account, you can take the choice of para 46 or 46A, where you can take it to the FCMITDA. Your journal entry will be FCMITDA account debit to loan of 500, and then let's say the loan tenure is 10 years, then every year 50 rupees will be going from the PNL, so PNL account debit to FCMITDA. Second possibility over here is that the loan may be attributable to a specific fixed asset. Again, if you decide the default choice, we will say loan is, whether it is for fixed asset or anything, if it is a loan, then the gain or loss will go to the PNL. However, if you decide to take the option under para 46 or 46A, then you are allowed to capitalize the foreign exchange differences along with the fixed asset, which will be spread off in the ratio of depreciation. Like for example, you use this loan to buy a fixed asset worth 8,000 rupees. Now, usually the fixed asset, let's say at 5, 10, 15, 20 years, whatever life, this 8,000 would have been depreciated over 20 years. Now, there's a forex loss of 500 on this loan. You will capitalize it along with the fixed asset. So, the fixed asset becomes 8,500, and thereby the depreciation over the next 20 years will be 8,500 divided by 20. So, rather than spreading it over and creating a separate account like FCMITD account, I will create and adjust the value of the fixed asset, and then my depreciation will keep on getting revised. Now, in the exam, if nothing is given, we will follow the default choice of AS 11. However, if it is specifically given that para 46A is applicable, then you can take the choice under para 46A. This is, remember, only for long-term loans. These are monetary items. It is not available for trade payables or even for short-term loans. This is only for long-term loans, where option 1 is forex gain or loss to be taken to the P&L account. This is by default. So, if nothing is given, we will follow this. However, or you can apply the choice of para 46 or 46A, that is on a general purpose loan. Show this in the FCMITDA, foreign currency monetary item translation difference account, and then transfer to profit and loss over the loan term or loan tenure. And specific loan for depreciable fixed asset, you will capitalize this along with the fixed asset and then record depreciation. Okay. Now this is the choice over here is one time and irrevocable. If you once take the choice, you can't keep on shifting between option 1 and option 2. If nothing is given, we will assume that we are following option 1 only. Okay, this is the first part. Second part of the standard is on foreign currency translation of financial statements of a foreign operation. We'll do that in some time. But before that, here it is written 0.6. Actually, it's best if you show this as 0.4, a separate point for something called as a forward contract. Now, what do you mean by a forward contract? Usually, you will go to the bank or the dealer to buy the dollars when you have to pay it if you are an importer, or when you receive it when you are an exporter. However, Let us say you have purchased goods today and the credit period is 4 months, or if you have sold goods today and credit period is 4 months. Now you are a very risk averse person. You are worried that what will be the position after 4 months, and hence in such a case what you can possibly do is you can go to the bank and say that I need the dollars not today but after 4 months. Bank says then you have to come after 4 months. We say no, but after 4 months whatever is the exchange rate I don't know, and hence I'm getting nightmares, sleepless nights. I want to fix today the rate at which I will buy the dollars if I'm an importer or sell the dollars if I'm an exporter after 4 months. So the bank does some working. It determines some rates. You will study this in CA Final in your financial management chapter on how these rates are determined from an accounting perspective at CA Inter. Just remember the bank will quote you certain rates. Let us say you are an importer who has agreed to buy goods for which you have to make a payment of $1,000 after 4 months. Today the spot rate is 80 rupees. I don't know what the rate will be after 4 months. So I'm worried. So on 1st January 25, when I actually do the import but I get a credit period of 4 months, the spot rate is, let us say, rupees 80 per dollar. But I don't have money to buy the dollars today. So I go to the bank and enter into a 4-month forward contract where the bank tells me that 4 months later you can come and pay me 82 rupees for every dollar. I'll give you $1,000 irrespective of the rate becoming 85, 95, 75, whatever it is. So this is like a insurance. This is like a protection. So we are saying now I'm not worried about whatever happens in the next 4 months. Let the rate go to 90 and 95. I don't care because I will get the dollars at 82 rupees. But even if the rate becomes 70 or 75, I'll still have to pay 82 rupees. But I'm okay with that because it gives me certainty. It removes my uncertainty. This is called as hedging. Hedging refers to risk reduction, where you have entered into a forward contract for which you are agreeing to pay 82 rupees, but this 82 rupees is not going to be paid today. It is going to be paid, let us say, after 4 months. Okay, you are agreeing to pay 82 rupees. Now you must have passed the entry as per AS11 at the exchange rate prevailing as on the date of transaction, that is purchases account debit to creditors. You must have passed the entry as on the rate on the date of transaction, that is 80,000 rupees. However, earlier what you used to do is, you used to say that this 80 can become 90, 95, monetary items, you will have to remeasure it at the closing rate. Now we say that whatever be the exchange rate, for this which is 80, eventually over 4 months, not immediately, over 4 months, I'll have to pay 82 rupees. So slowly, I will amortize the 80 and take it towards 82 rupees. This is called as forward premium. Like insurance, you pay a premium. Over here, let us say, you are paying 2 rupees extra. You are agreeing to pay 2 rupees extra. For something which is worth 80, you are agreeing to pay 82, and as a result, over here, there will be a calculation of a forward premium. Forward premium is calculated as a forward rate. Sometimes it is premium, rarely it is discount, but let us say most cases in the institute material it is a premium. Forward rate is 82 minus the spot rate, which is rupees 80, and hence if I take the difference, this is rupees 2 per dollar. I'm agreeing to pay 2 rupees extra per dollar. Now what do you do with the 2? Will you record it immediately? Will you wait for 4 months? Well, it is like an insurance premium. It is helping me mitigate the uncertainty for the 4-month period, and hence you will record it over the 4 months. To kind of draw a parallel, it is like when you did AS16, there was a zero coupon bond. In a zero coupon bond, we said that the issue price is 60 rupees. After 4 years, you will redeem at 100 rupees. So we are saying we are paying 40 more, but that 40 more is not for today, not for 4 months, 4 years later. It is over the 4 years. In a similar way, slowly you went from 60 to 70 to 80 to 90 and then ultimately 100. In a similar way, I am showing the creditor today as 80. However, eventually I have to pay 82. So from slowly, not suddenly, I am going from 80 to let's say 81 to let's say 82. So you will amortize it. So this is a forward premium, and AS11 says that this forward premium will be recorded over the contract tenure, which is over 4 months. So let us say in the current year, in the year 24, 25, 3 months are there, in which case I would say, okay, it's $1,000 into rupees 2, that is 2,000 rupees into 3 by 4. In the first year, from 1st January to 31st March, 3 months are done, and hence you will record 1,500. This is P&L debit, forward premium amortization. Let us say to liability, something like a creditors will be credited by 1,500, and then in the next year, in the year 25-26, one more month will be into 1 by 4, and hence 500. So eventually your creditors or your payables will move up to 82,000, and then you will pay them off by buying the dollars at 82,000 rupees. So in case of a forward contract which is taken for hedging, and how will I know it is for hedging? There will be an underlying, for example, payable, maybe creditor, loan, whatever it is, for which you are taking protection. So there is an underlying at 80 rupees for which you are committing today to pay 82, and hence you are agreeing to pay 2 rupees more, and hence you will spread that over the 4-month period. So over here, hedging, that is risk reduction for a forward contract. On the date of the forward contract, you will determine the forward premium. In our example, 2 rupees per dollar. That is difference between the forward and the spot rate. And this forward premium will be spread over the tenure of the forward contract on a straight line basis, like when insurance premium is spread. Subsequent forex movements now will not be considered. You don't now have to see anything further because you have to pay 82 only. However, sometimes it might happen is you might enter into a forward contract for speculation. You don't have an import, you don't have an export, you have not taken a loan, you have not given a loan. However, you are a speculator. You speculate that the 4-month forward rate is available at 82. Now you are fairly certain based on your analysis that the rate after 4 months is likely to be 85. So you are saying that I'm getting a chance to buy or sell as a case maybe today, that is on 1st January 15 dollars at 82 when I expect the rate to be 85. So what I do is probably I enter into a contract which is a buy forward contract. Sir, why am I buying forward? I mean, the question will tell you that, but intuitively I'm buying the forward because I believe that the rate will be 85, but I'm getting a chance to buy it 82. So saste mein mil raha hai, it is getting at a cheaper rate, and hence I will buy it 82. So over here, let us say this will be a buy forward. Achha, when I enter into a forward contract, you need to remember that it is just a piece of paper that you enter into with the bank. Today, you don't pay anything to the bank. Today, the bank does not pay anything to you. After 4 months, you will go and pay 82,000 rupees to the bank. The bank is likely to give you $1,000. And if your expectations are correct, what will you do with that $1,000? You are not an importer or anything. You will go and sell that $1,000 in the spot market. Maybe if your expectations are correct, you will get 85,000 rupees and profit of 3,000 will be earned. So you are a speculator. So you will buy the forward. Now what will happen is on 31st March 15, that is on the balance sheet date, of the 4 months, 3 months are done, 1 month is remaining. So the 1 month forward is available, let us say, at the rate of rupees 86 per dollar, which means on 31st March, if someone were to enter into a piece of paper which says that they want dollars on 30th April, the rate is likely to be 86. So people are expecting the rate to be 86. And hence your piece of paper, which is entitling you to buy the dollars at 82, whose rate is now likely to be 86 per dollar, your piece of paper has a 4 rupee gain. It will allow you to buy something at 82, which you can actually sell for 86. And hence 4 rupees per dollar is your gain. So you will calculate a forward gain or a forward loss. Here you will not, this is not forward premium. Sir, why no forward premium? Spot rate today, maybe. Spot rate over here also may be 80. Yeah, but I don't have a liability or anything at 80 rupees. Earlier for hedging purpose, I had a creditor to whom I had to pay $1,000. When I recorded the creditor, the rate was 80, for which I am agreeing to pay 82. Here I don't have to pay anything, anyone at 80. So it is just a fresh contract. So the spot rates over here will be ignored. It is a fresh contract at 82, which you have agreed to buy. On 31st March, you can decide to sell this off, transfer it to someone else. So you will say, well, when you transfer it to someone else, you will say this piece of paper will entitle you to buy the dollars at 82, which in the market 1 month later will be available at 86. And hence my piece of paper is worth 4 rupees. And that is your gain. Your entry on 31st March 2015 will be forward asset account debit to forward gain in the P&L account by directly comparing 86 with 82, and that is at 4,000. So over here, over the year, let's say 14, 15 or 24, 25, whatever it is, I will recognize 86 per dollar minus 82 per dollar into $1,000, and hence this will be a gain of 4,000 rupees, which will be taken in the P&L. However, it is not necessary that your expectations are correct and the rate may not necessarily be 86 rupees. It might actually in the next month become 84 rupees or 81 rupees or whatever it is. Then you will again compare. You will say that ideally I had a commitment to buy something at 82. Let us say the rate becomes 83, which means I have a 1 rupee gain. However, or let's say the rate becomes 87. Then 87 minus 82, there's a 5 rupee gain. But out of that 5 rupees, 4 rupees is already recorded. And hence the additional 1,000 or 1 rupee will be recorded. So long story short, it's a little complicated, but long story short, in case of a speculation, you will compare the relevant rates for the forward contract and figure out whether there is a gain or loss. premium calculation, premium amortization is not there. In case of hedging, comparison of forward rates is not required, because once you enter into the forward contract, you have sure that for something worth 80, you are paying 82 and 2000 is your extra loss, and that loss is going to be recorded. After that, what the rates turn up, well, we don't really care. So over here, speculation, in order to profit from the exchange rate movements, there's no forex receivable or payable. That is when you say it's a speculation. First, determination of forward premium not required. Why? Because you don't have a liability at 80. So you can't say that for something worth 80 you are agreeing to pay 82. You're not agreeing to pay 2 rupees extra for anything. There's no liability at 80. So you don't have to have forward premium. Instead, recognize a gain or loss by comparing the current exchange rate, that is on the balance sheet date, with the settlement date, with the agreed forward rate. So you are comparing, for example, 86 with the agreed rate of 82 at a later date and figuring out whether there is a gain or loss. Most questions that the institute has given is for hedging, but there can be questions regarding speculation as well. So this is regarding forward contracts. And the last over here is on something called as foreign operation. Now you will do this at a lot of length when you do the chapter of branches. In branch, there will be a section on where we can say that there are foreign branches, and how will you convert the trial balance of the foreign branch into your currency? Well, you will have to apply this AS 11 principles. So at a theory level, in this case, what is happening? You are not doing any foreign currency transaction per se. However, you have a trial balance which is let us say for a foreign which is for a foreign branch, like Tata Motors has a foreign operation, let's say Jaguar and Land Rover in the UK, or SBI has so many branches in India, but it also has a branch in the UK. So when I prepare the financials, balance sheet for SBI, for Tata Motors, I'll prepare it for the entire company, and hence all my Indian branches, foreign branches, subsidiaries, all of them will come together, and that will give me my total position. Now the problem is, this foreign branch was located in the US and hence had recorded everything in US dollars, or JLR, Jaguar and Land Rover, located in the UK and hence recorded everything in the UK pounds. So what will I have to do? Well, I must have recorded my entire trial balance in pounds, but I need to prepare my accounts in rupees, and hence I will have to convert each of these items into rupees at some predefined rates, for which the standard gives you certain guidance. So it says that before you select which rates, you figure out what type of operation it is. There are two types of operations. One, there is something called as an integral operation. As the name goes, it is integral, or it is like an extension of your entity. Second is a non-integral operation, which is largely independent, and it is not like an extension of your entity. One example of an integral operation is a dependent operation. Like for example, you have decided that you will import goods from China and sell it, let us say, in India or overseas. So you are doing imports. So usually every year you go to China, you import goods, go to China, import goods. So you are actually doing foreign currency transactions. You are paying in Chinese yuan. However, you now decide that every time going to China is a little tedious. You set up a small subsidiary or a branch or an office in China, and you give them certain money. Using that money, they buy the goods, they give you the goods, and then you decide to do what you want to do with the goods. Now, this branch or an office of China is fully dependent on the Indian operation. For anything, it will need money. For India, the goods that it gets, it will send back to India, and hence it is dependent, it is integral. So when my branch buys goods in China, it is as if I am directly buying those goods in China, because the money for those goods will be paid by me only over here. And hence it is called as an integral operation, and the accounting for an integral operation is done exactly the same way as you studied earlier. That is, incomes and expenses of that branch will be converted at the rate on the date of transaction, if that is not available at the average rate. Monetary items of that branch, let's say debtors, creditors, whatever it is, will be converted at the closing rate. Non-monetary items will be at the historical rate, and any gain or loss that will arise will be going into the profit and loss account. Why? Because that money will actually be transferred. If I have to pay something in the Chinese yuan, Indian operation will actually use the rupees to buy the yuan and pay them. Or if they have to remit something back to India, they will repatriate, because it's a dependent operation. On the other hand, when you have an independent branch or a non-integral operation, what does it mean? Like JLR has the ability to finance its own operations. For every time it needs money, it will not go to Tata Motors. It can sell its own goods, use that money to pay off its own expenses, its liabilities, and hence usually JLR, what it will earn in pounds, it will not remit back that money in India. In fact, it will use that money which is in pounds to pay its expenses and liabilities in pounds only, and hence that money from pound to rupees will not actually be remitted, and hence the gain or loss will not be realized till the time all the money is remitted. But because it is an independent operation, that money is going to remain in pounds only by and large. And as a result, over here AS11 says that in such a case it's a non-integral branch. The gain or loss, if any, on the exchange rate, it is just on paper. You will have to convert everything in rupees, but that is just on paper for the purpose of preparing your accounts. Otherwise, that money in pounds is not going to come back to you, and hence if there is any gain or loss, this will not be taken to the profit and loss account. In fact, it will be kept in an account called as foreign currency translation reserve, called as FCTR, and will remain in FCTR till the time you dispose of the entire foreign operation. That is, for example, when you sell the entire JLR branch, when you sell the entire JLR operation, that is when there will be, let us say, some gain or some loss, and that gain or loss will be taken at the time of sale. Like Tata Motors decides to sell it to some other company, then the entire pounds will come back to India. Pounds for all the monetary and non-monetary items will all come back to India, but till that time it will, because it is an independent branch, the money will be in the UK. Simplistically, we can say that when you are, let us say, before your articleship or before you become a CA and start earning money, you are like a dependent. And when you study income tax says parent and the minor is like one and the same. Why? Because parent and minor is one and the same. I mean, you are largely dependent on the parent, but once you start earning, you are largely independent. You meet your own expenses. And as a result, the accounting over here, like for integral and non-integral, will be different. So over here, foreign currency translation for foreign operation, which can be a foreign branch, subsidiary, JV or associate institute, only has 1 or 2 questions over here in AS11 section. More questions are there in the foreign branch section. So integral, that is dependent, treated as an extension of the enterprise. Integral branch is not able to finance its own operations, whereas non-integral is like independent and treated as a separate operation, and it is capable of financing its own operations, meeting its own expenses, paying off for its own liabilities. For each of these operations, incomes and expenses will be recorded at the rate on the date of transaction, and if that is not there, then the average rate. So rate on the date of transaction or average rate, rate on date of transaction or average rate. But for assets and liabilities, in case of an integral operation, this is same as that of the earlier part, Monetary items will be at closing rate, non-monetary items at historical rate. If these non-monetary items are shown at fair value, then the rate on the date when fair value is determined, and the gain or loss will go to the P&L. Why? Because eventually, sooner or later, because it is dependent, the money will be repatriated, transferred between the two parent and the head office and the branch, and hence the gain will be realized. However, when you look at non-integral operation, monetary assets even here are going to be showing at the closing rate only. But even non-monetary items, this is where it differs, are going to be shown at the closing rate. Why? Because ultimately the gain or loss is not going to the P&L account, and hence the institute says that let the non-monetary items also be at the closing rate, because ultimately the money will come from UK to India when I sell the entire JLR, that is a monetary as well as a non-monetary part, and hence I will convert even the monetary as well as the non-monetary items at the closing rate, and whatever is the gain or loss, I will take into the foreign currency translation reserve. It will be a separate reserve, like in AS10 you have the revaluation reserve. You keep the money in the revaluation reserve till the time you sell the fixed asset when you transfer it. In a similar way, till the time JLR is operating independently, I'll keep it as FCTR. But the moment I decide कि भाई ठीक है JLR को मेरे को बेच देना है, let's say to Tesla or someone, then Tesla will give me money, let's say 5 billion pounds, and those 5 billion pounds will be for both monetary and non-monetary assets, and hence the entire money I will get back to India, and that is when the gain will be realized. So over here there will be foreign currency translation reserve. One needs to remember that non-monetary items are usually converted to the historic rate only. However, in case it is a non-integral operation where you have to convert these non-monetary items, AS11 allows you to convert them at the closing rate. Usually foreign exchange gain or loss is going to be taken to the P&L only. However, if it is non-integral operation, then the foreign currency gain or loss will be taken to the FCTR. Now, if the question tells you that the branch is dependent, it is very easy, it is integral. If they tell you it is largely independent, then it is very easy, it is non-integral. But what if the question remains silent? And most of the institute questions do remain silent. In which case, what has the ICI done and what should we do? We will generally take the easier approach. See, integral, you don't have to study anything new beyond what was studied earlier. You are going to follow the same principles. So if nothing is going, usually we assume that the operation is integral. That is what the institute has done even in its study material. However, if you are, so hints for integral can be, there are a lot of transactions between the parent and let us say the subsidiary or the head office and the branch, so it is integral. But if question specifically non-integral, then we take independent. But having said that, you can always write a note and make another assumption. Now the problem over here is, you have calculated a foreign currency gain or loss, let's say for a debtor, for a creditor, etc., by comparing loans, by comparing individually. Now for a foreign operation, there may be so many items that have happened throughout the year. Now for individually, if you sit and calculate, it will take a lot of time, and hence how do you calculate foreign currency gain or loss for a foreign operation? You will look at the trial balance in the foreign currency, whether it is integral or non-integral. You will look at the trial balance in the foreign currency. The trial balance in the foreign currency would ideally tally. Now what will happen is, you will apply the specific exchange rates. Some items you will apply rate on date of transaction or average rate, some items you will apply closing rate, some items you will apply historic rate. So there will be a mess. You will apply different exchange rates. Now ideally, after applying those rates, if you see the total of the trial balance, it will not tally. Now why is it not tallying? Well, it was tallying in dollars, it is not tallying in rupees, because you applied different rates, and hence the difference, if any, in the trial balance is the cumulative difference because of all the differences in exchange rate, and hence that balancing figure, in practice people do that, as a balancing figure of the trial balance will be taken as a foreign currency gain or loss, to be taken to the P&L for a integral operation, to be taken into the FCTR for a non-integral operation, but you will calculate it as a balancing figure, for example in the balance sheet or in the trial balance. Okay, so over here we can say point 3, forex gain can be calculated by converting the trial balance into rupees by applying the applicable exchange rates, and the balancing figure in the trial balance would be due to exchange difference only. Now this exchange difference for an integral branch will be taken to the P&L account, but for a non-integral branch will be taken into FCTR, foreign currency translation reserve. Now the problem also is that some cases there are inter-group transactions, like goods sent by the HO to the branch, goods sent by the branch to the HO, money remittances done by the HO to the branch, branch to the HO. There will be an HO account in the books of the branch or a branch account in the books of the HO. You will do all of this at a lot of length once you do branch accounting. But nevertheless, you should realize that maybe it is possible that the head office, which is in India, is supplying something to the branch. So there may be some goods sent to branch, or the branch has to pay some money still to the head office. So there will be a payable to the head office in the books of the branch. Now the thing is, when you decide to join both of these and prepare one single financial statements, I can't have an income from my own self or an expense to my own self, or a receivable or a payable from my own self, and hence they will have to cancel. So basically, if it is goods sent in one of the books, let's say HO is sending, so this is goods sent, there must be goods received in branch books, or if it is a payable to the head office in the branch's books, there may be a receivable from the branch in the head office's books, and hence there would be intergroup transactions. Now the thing is, in one of the trial balances it will be recorded in rupees, in another trial balance it will be recorded in dollars, but ultimately once they are converted into the same currency, they should be eliminated, and hence all of these intergroup transactions will be converted at actuals, which means in the parent or head office, assuming it is in India, whatever the rupee balance which is there, that same rupee balance will be taken. You will not take the average rate, not take the historic rate, not take the closing rate, you will take the actuals. This might be a little tricky to understand if you have not done branches, but if you do a sum that we are going to do, you will get a good enough understanding. So over here you will have point 2, goods sent or received from branch or head office as well as other inter-branch balances should be recorded based on actuals. Since the Indian operation would have recorded the amount in rupees, and exactly that amount will be recorded on translation for the foreign branch, so that the balances one company's receivable and other company's payables will exactly eliminate. Depreciation in general will be recorded at the rate at which fixed assets are recorded. If fixed assets are recorded at historical rate, depreciation will be based on that. If fixed assets are recorded at closing rate, depreciation will be based on that. Okay, a few other points is, if nothing is given, the branch can be assumed to be either integral or non-integral, but in line with ICS solutions, we will assume integral. Significant goods received or remittances or transactions actually give you some evidence for saying that this must be an integral operation. And the balance of FCTR in case of non-integral operations will be transferred to the P&L at the time of disposal. So when you sell entire JLR, that is when the balance of the FCTR will be transferred to the P&L. So this is about AS11. This last section, I would say, if you do branches and do a few sums on that, you get better clarity. Though we will do sums and we will apply and do the sum which the institute has also given in study material. So we will go to the questions now for AS11. Again, we have a few questions that we have put in our LDR section at the top, and there are quite a few questions which are similar for your practice. We will discuss all the questions so that you get some clarity, but key focus on these questions when you are revising for the last day. So let us go to the questions. We'll go to question number 1. Now Kalim borrowed $4,50,000 on 1st January 16, which is repaid on 31st July 16. So basically it is a short-term loan. Okay. Kalim prepares financial statements ending 31st March 16, that is after 3 months, and the rate of exchange between the reporting currency INR and the foreign currency USD at different dates are. So we have been given the rate on 1st January 16, 31st March 16 and 31st July 16. So over here you have borrowed $4,50,000. So you will first on 1st January, so you will take the exchange rate as on the date of transaction, 4,50,000 into 48, that will be 2 crore 16 lakhs. So if you have to pass journal entry, you will first record the loan, bank account debit to loan, that is 2 crore 16 lakhs first. Now come 31st March, it is a monetary item. This loan is a short-term loan which is a monetary item, and monetary item has to be restated at the closing rate. Closing rate is 49. So for something which is worth 48, I'll have to pay 49, and hence I'll have to pay 1 rupee more. So that is a loss for every dollar into 4,50,000. So that is 4,50,000 rupees. Forex loss, where will it go? Sir, PNL. Can I apply 46A? No. Why? Because it is a short term loan. 46A, even if the choice was to be applicable, an assumption given that has to be for a long term loan. This is a short term loan, and hence this has to go to the PNL Forex loan account debit. Let us say Forex loss account debit in the PNL 4,50,000 to, let's say, loan 4,50,000. This is your second entry. And third is when you actually sit and make the payment. When you sit and make the payment, the rate has become 49.5. So when you write the check, interest rate is not given, so 4,50,000 into 49.5, you cut the check of 2 crore 22,75,000. So something account debit to bank 2 crore 25,50,000. So this is 2 crore 75, 2 crore 27. क्या लिखा हुआ है 2 crore 22,75,000. Yes. Now loan will be debited. Loan will be debited by how much? Well, whatever you have credited, 2 crore 16 plus 4,50,000. So your ledger has 2 crore 20 lakh. 50,000 of loan, and hence the balancing figure, if any, will be further forex loss will be taken to the P&L account. So that is about it. So this is a good question for AS11, and there is a similar question later on similar lines. We'll quickly discuss that, but as of now, this is a good question from an exam perspective. Okay, next you go to question number 2. Opportunity Limited purchased an equipment costing 24 lakhs on 1st April 15, and the same was fully financed by a foreign currency loan. So there's a specific loan for buying an asset, payable in 4 equal installments. Exchange rates were rupees 60 per dollar and 62.5 on 1st April 15 and 31st March 16. Now the first installment was paid by 31st March 16, and the entire difference has been capitalized. You are required to state how these transactions would be accounted for. So in such cases, you will first try to find the loan amount, which is rupees 24 lakhs divided by rupees 60 per dollar, that is exchange rate as on the date of the transaction, and hence this will come to probably 40,000. So your loan is 40,000, and every year $10,000 is going to be paid. But by the way, the first installment was also paid on 31st March 16, and so $10,000 is paid on 31st March 16. The remaining $30,000 are still remaining on 31st March 16 only, and hence the entire $40,000, that is 10 which is paid, and hence forex gain or loss if any realized, and the remaining 30 which is not yet paid, and the gain or loss unrealized are still on 31st March 16 value. So being a monetary item, you have to remeasure this at the closing rate. So this is the difference between 60 and 62.5. That is rupees 2.5 per dollar into so for the total $40,000, you will have a 1 lakh rupee. Now, ideally, what will you do with this loss? Well, this is a loss on the long-term loan. This loss can go to the P&L account in case you follow AS11 usually. However, it can be capitalized along with the fixed asset in case you follow para 46. Is a question telling you to follow para 46? And then, if you assume para 46 is not followed, then the treatment is wrong. This 1 lakh has to be taken to the profit and loss account. However, if para 46 was followed, this was a specific loan for an asset, in which case 1 lakh can very well be capitalized. So over here, if you see, the treatment it is correct, assuming the entity decided to take action. Para 46, however, in case the entity has decided to follow regular provisions of AS11, the entire 1 lakh will be taken to the P&L. And this 1 lakh is calculated as $40,000 into the difference, and 40,000 will include $10,000 जिसके ऊपर gain or loss आएगा of 2.5 or something worth 60. You actually paid 62.5 for $10,000. For the remaining $30,000 you have not yet paid, but being a monetary item you have to convert at the closing rate, so a further 2.5 loss. Institute does this directly. You can even show 10,000 and 30,000 separately and so on. So this is for question number 2. Now question number 3 is on that foreign branch. A business is having a head office in Calcutta, that is in India, and a branch in the UK. So the UK branch will have its financials in pounds, whereas the Calcutta operation will have everything in rupees. The following is the trial balance of the branch on 31st March 16. So given the trial balance on 31st March 16, a lot of these items are given, and then on the next page, closing stock at the branch was 700 pounds. This is an adjustment, it is outside the balance sheet, so you will convert it separately. Depreciation at 10% to be charged on the fixed asset. Again, it is an adjustment. Institute shows it separately. One can always say that you can rectify the trial balance and show. Institute keeps it simple and shows it separately. We will also show that. Prepare the trial balance after being converted into rupees. Okay. Exchange rates in pounds on different dates are: on 1st April 13 it is 61, on 1st April 15 it is 63, and on 31st March 16 it is 67. So these are 3 rates given to you. The question unfortunately does not tell you whether it is an integral branch or a non-integral branch. We will assume that this is an integral branch if nothing is given in line with the institute solutions. Now if it is an integral branch, you will convert the non-monetary items at the historical rate. So fixed asset which is non-monetary will be at the historic rate, that is rate on 1st April 2013. Monetary items will be at the closing rate, whereas incomes and expenses will be at the rate on the date of the transactions, and if that is not available, that is the average rate. Now how will I calculate the average rate? Well, 63 per dollar, that is the rate at the start of the year, 67 per dollar at the end of the year, and hence if I take the average, it is 65. So what will I do? I will convert fixed assets at the rate of 61, that is the rate on the date when fixed assets were purchased. Debtors are monetary items at the rate of 67. Opening stock is opening at the start of the year, and hence this will be at the rate of 63. Goods received from the head office recorded in HO books at 4,02,000. Now this will be converted at actuals. This will appear at 4,02,000 only. Sales will be converted, let us say, at the average rate, which is 65. It is income. Purchases again at the average rate 65. Wages again at the average rate 65. Salaries again at the average rate 65. And cash will be at the closing rate, being a monetary item, at 67. So these are the numbers that you will take. Remittances to head office. This is actually, I think, 2,900 or something in the pound currency. Recorded as rupees 1,91,000. So you will over here record exact 1,91,000. Head office accounts have money payable to the head office of 7,400 pounds, recorded in HO's books at 7,900. So HO must have recorded a receivable of 7,900. So I will convert and show a payable, sorry, of 4,900 only, or 4,90,000. Creditors are monetary items, will be converted at the closing rate, and that is about it. So once it's then a mathematical process, you apply 61, 67, 63 for opening stock. This is actuals, as you can see, 4,02,000. Then 65, 65, 65, everything at the average rate, cash being at the closing rate. Again, this is actuals. Head office, again, this is actuals. And then you will take the total. The total was tallying in pounds, will not tally in rupees, and hence the balancing figure will be forex loss. Where will this be taken? Sir, it will be taken to the P&L, because you are assuming this is a integral operation. Sir, what if this was given to be non-integral? Then what will be the changes? Well, in this case, your fixed assets will be taken at the closing rate. Non-monetary items, stock also will be taken at the closing rate. And everything else, well, monetary items will still be at the closing rate. Incomes and expenses will still be at the average rate, and hence there will be everything else which are actuals will still remain at actuals, and hence the foreign exchange loss, which is the balancing figure, instead of P&L, will be taken to the foreign currency translation reserve, also called as FCT. Okay, for closing stock as well as depreciation, Institute shows this closing stock at the end of the year, so 67. Depreciation will be the rate on the fixed assets, which is 61. They show it separately, so we also do it. Another alternative could be you rectify the trial balance and prepare everything, but Institute avoids doing that, so we also avoid doing it. So this is pertaining to question number 3. Okay. Then you go to question number 4. This is on forward. Rao Limited purchased a plant for $1 lakh on 1st February 16, payable after 3 months. Okay, so it must be payable by 30th April 2016. Company entered into a forward contract for 3 months at the rate of 49.15 per dollar. Now, this must be the forward contract to protect against this payment, and hence this is for hedging. Exchange rate per dollar on 1st February was 48.85. This must be the spot rate, and the forward contract is entered into at 49.15. So this is the forward rate. How will you recognize the profit or loss on the forward contract in the books of Rao? So first we have to figure out whether this contract is for hedging or for speculation. We say that there seems to be a liability to be paid, and hence the forward contract is taken to meet that liability, and hence it is for hedging. So how will you do this calculation? We will say that today, that is on 1st February 16, the forward rate agreed is 49.15 against the spot rate of 48.85. So today I must have recorded a liability at 48.85, but I've agreed a forward rate of 49.15, and hence I've agreed to pay 0.3 extra per dollar, and total into how many dollars? 1 lakh rupees, 1 lakh dollars, and hence I've agreed to pay 30,000 extra. Now this 30,000 extra is to be paid after 3 months, and hence you will record the forward premium amortization. So in the year 16-17, 2 months are there, February and March, and hence 30,000 into 2 by 3 will come to probably 20,000 will be recorded in the P&L, and corresponding credit to the liability of 20,000. And then in the year 17-18, where the month of April is there, 30,000 into 1 by 3, which will come to 10,000, and this 10,000 will also be taken to the P&L account. Are we clear with this? Okay, so this is for hedging. Next, if you compare this with question number 5, which is largely for speculation, Mr. A bought a forward contract for 3 months of $1 lakh. That's it. They've directly bought a forward contract. They have not been telling you that I had a liability to pay after 3 months. No, you've just bought a forward contract on 1st December at the rate of 47.1. So this must be your forward buy rate, when the exchange rate was 47.02. So technically 0.08 is a premium, but that premium you will record only if it was a contract for hedging. On 31st December, when he closed his books, the exchange rate was 47.15, and on 31st January, he decided to sell the contract at 47.18. वैसे तो contract का 3 महीने का time था, 1st December से लेके 1st January, 1st February, 1st March. However, I did not wait for 1st March. I'm a speculator. When the time is right, I can sell the contract. I originally agreed to buy the dollars. Now, I've sold that even before maturity, so I'm more like a speculator. Show the profits from the contract to be recognized in the books. So over here, we can say that there would be surely no forward premium, because this contract seems to be for speculation, and hence 0.08, yes, you might be agreeing, but in hedging, there must be a liability at 47.02, which you are agreeing to pay at 47.1, and hence 0.08 extra. Here, there's no liability at 47.02. You have just entered into a piece of paper to buy the dollars at 47.1. However, on 31st December, that same piece of paper, if someone else wants to enter, the rate prevailing is 47.15, and on 31st January, you sold at 47.18. And hence there is a possible gain. You have agreed to buy at 47.1 something which by 31st December is worth 47.15, and hence you are getting 0.05 extra. By 31st January, the rate has become 47.18. So you have agreed to buy something at 47.1, which is now worth 47.18. That is 0.08 extra. However, out of that 0.08 gain, 0.05 is already recorded, and hence the additional 0.03 will be recorded. So assuming 31st December was the year ending, on 31st December, I will say 47. If I had to sell today, I will sell at 47.15, something which I have agreed to buy at 47.1, and hence on every dollar, this is again into $1 lakh. So there will be a 5,000 rupee gain, which is to be recorded in December. When I come by 31st January, I will sell this and get 47.18, something which in my books I said was worth 47.15, and hence into $1 lakh. The extra 3,000 I will record as a gain in the next year. Let us say if my year ending was not 31st December, then I will not look at anything on 31st December. I will directly compare, and I will say I am selling something at 47.18, which I agreed to buy at 47.10, selling price minus cost price. Simple, I am a speculator. Into $1 lakh. Institute ने यही किया directly. That is, they have recorded a 8,000 rupee gain. Now, what we have done is we have said out of the 8,000, 5,000 will be recorded in the first month. If you are closing the books in December, 3,000 will be recorded in the next month. However, if your books were closing by 31st March, the entire 8,000 would be recorded as a gain on the forward contract. Okay, so speculation, this is one of the very few sums that are there, so you can practice this, but largely most of the sums are pertaining to hedging. Okay, next question 6, this is very similar to question 2. So we'll quickly review this. A purchased assets costing 3,000 lakhs and the same was fully financed by a loan of US dollars payable in 3 equal installments. Exchange rates were 40 and 42 on 1st January and 31st December. So that means your loan amount is 3,000 lakhs divided by 40 comes to around 75 lakhs. The first installment was paid on 31st December, that is by the end of the year. Entire difference has been capitalized. State how these transactions will be accounted for. Well, this is a monetary item and hence 75 into 42.5 minus 40, that is 2.5. So 75 into 2.5, that is equal to 187.5 will be taken to the profit and loss account. However, if para 46A was applicable, then this could have been capitalized. So over here, this is around if I go to see, this is rupees 187.5 lakhs. Okay. Question number 7. This is more of a theory question. We'll quickly review this. Assets and liabilities and incomes and expenditures in respect of foreign branches which are integral are translated into Indian rupees at the prevailing rate of exchange at the end of the year. Now this is fundamentally wrong. Why? Because incomes and expenses have to be converted at the average rate or the rate on the date of transaction. They will not be at the closing rate. Assets and liabilities, out of which if there are monetary items or liabilities, they will be at the closing rate, but non-monetary in case of an integral branch will be at the historical rate. So this is wrong. The resultant exchange differences in case of profit is carried to the other liabilities account, which is wrong. It will be taken to the P&L, and loss, if any, will be taken to the P&L, which is correct. Comment. Well, there are 3 points of differences. First, incomes and expenses should be recorded at the average rate or rate on the date of transaction, not at the closing rate. Second, non-monetary items have to be recorded at the historical rate and not at the closing rate for integral branches. And forex gains or losses have to be taken to the P&L account. It is not that the gain is taken to other liabilities and loss is taken to P&L. Whether it is a gain or loss, it has to be taken to the P&L account. So this is the error over here in question number 7. Question 8 is a very basic question. Classify whether they are monetary or non-monetary. Share capital, non-monetary, because, well, the amount of dividend etc. to be paid is not fixed or determinable and hence non-monetary. Trade receivables are monetary. Investment in equity shares also non-monetary because the amount that I will get as dividend etc. is not very sure. And fixed assets also non-monetary. Okay, so this is question number 8. Next you go to question number 9. A basic question, I would say. Goods purchased on 1st January 17 for $15,000 when the rate was 75. So this is 15,000 into 75. I will have 11 lakh 25,000 as a liability. If this is purchased on credit, exchange rate on 31st March 17 and date of actual payment is 7th of July 17. So I have to remeasure this at 74 and hence if I take $15,000 into 74, my liability will come to only 11 lakh 10,000 and hence there would be an FX gain of how much? 1 rupee per dollar into 15,000 and hence there will be a 15,000 rupee gain. But when you actually go to pay, the rate is 73. So you actually pay only 15,000 into 73. That is, you are paying 10 lakh. Again, 15,000 into 73. You are paying 10 lakh, 95,000. And hence there is a further gain, a forex gain, I think, of 15,000. So over here, there would be, if we go to see, 15,000 gain in the year of payment and 15,000 gain in the first year in the P&L. You can directly do this calculation by comparing 75 and 74 into $15,000 and then comparing 74 and 73 into $15,000. Okay, question number 10. Over here, there is one particular adjustment. It is an exam question which is a little tricky. Explain briefly the accounting treatment needed as per AS11 as on 31st March 2020. Debtors include an amount due from Mr. S for 9 lakh rupees recorded at the prevailing rate on the date of sales. Transaction is recorded at 72. So basically your debtors would be rupees 9 lakh divided by rupees 72 per dollar and hence debtors would be $12,500 which is recorded at 72. Acha, US dollar on 31st March 2020 is 73.5 and the start of the year is 72.5. Now debtors or monetary items have to be restated at the closing rate, that is at 73.5. Currently they are appearing at 72. That is the rate on the date of transaction, and hence there will be a forex gain 12,500 into rupees 73.5 per dollar at the end of the year, minus they are appearing at 72 per dollar, and hence 12,500 into 1.5, should say 18,750. This must be the gain. Sir, kyun gain? Because it is a debtor. I thought I'll receive 72 for every dollar. Now I'm going to receive 73.5, so I'm going to receive more. It is a gain. If it was a creditor, it would be a loss. Now this is where things get a little rough. Second part, long-term loan taken on 1st April 19 from a US company. Loan is taken on 1st April 19, that is at the start of the year, amounting to rupees 75 lakhs. So this is given in rupees. 5 lakh rupees was repaid on 31st December. This is a problem area and recorded at 70.5. So when you were repaying, you repaid 5 lakh rupees, but that 5 lakh rupees was repaid when the rate was 70.5. So you'll have to figure out how much dollar was paid. Interest has been paid and has been debited by the US company. We have not been given the rate of interest, and US dollar is 73.5 on 31st March 2020 and 72.5 on 1st April 2019. So what will happen over here is, for this loan, you will first figure out what is the loan amount. So you will say the loan was, I think, 75 lakhs, which was taken at the start of the year when the rate was 72.5 per dollar, and hence 75 lakhs divided by 72.5, and you get $1 lakh 3,448.28. Let us add the loan balance. Now out of this loan, some part of the loan is repaid. How much of the loan is repaid? We can say rupees 5 lakhs is repaid, but that is in rupees. It was repaid when the rate was 70.5 per dollar, which means 5 lakh rupees divided by 70.5 comes to around $7092.20 is the amount repaid. Now this was repaid when the rate was 70.5, but you had recorded every loan balance at 72.5, and therefore there would be a forex gain on the repayment of 7092.2 per dollar into rupees 72.5, which is your ledger balance of the liability, but when you paid, the rate was only 70.5, that is 2 rupees per dollar. So into 2, you will get around rupees 14,184.4. So this would be my forex gain, but there is some amount which is still outstanding. Now in dollars, this would be $103,448.28 minus $7092.2. So this is 103,448.28 minus 7092.2. This is around $96,356.08. Now this amount is still outstanding at the end of the year, and hence it has to be restated at the closing rate. Now as per ICAI, they have correctly done this into 73.5, which is the closing rate. So this will come to rupees 70,82,171.88, for example. So this is my loan balance, which is recorded, let us say, in rupees. However, what ICAI has done is, you will compare, and in my opinion, alternative treatment is possible, but if it comes, you might as well do it the way Institute has done. So ICAI says that this will be the balance as per AS11. However, in your books, your loan must be appearing at what? Well, I started at 75, out of which 5 is repaid, and hence as per ICAI, this loan must be appearing remaining at 70 lakhs in your ledger, and hence remaining there would be a forex loss, because something which is worth 70 lakhs is now to be shown at 70 lakh 82,171. So there is a forex loss of 82,171.88. Now in my limited understanding, an alternative treatment is possible, because ideally one can say that this 96,356.08 in your books must be at 72.5, and hence whatever is the excess, that would be taken as a gain or loss. But Institute has not done that. So to keep consistency with the Institute, if a similar question comes, do it the way Institute does, though an alternative treatment in my opinion is possible, and in fact more appropriate as well. So your net forex loss would be a loss of 82 and a gain of 14. So this is 82,000 171.88 minus 14,184.4, and hence net, there is a net forex loss of 67,987 point something, which will be recorded in the profit and loss account. So over here, this is 67,987.48. As you can see, what the institute has taken, though we have mentioned that an alternative treatment is very much possible. Okay, so this is question number 10. In 11, this is similar to 4. So this is on hedging. You can pause and try the hedging question on your own if you want. Axe purchased fixed assets costing $5 lakh on 1st January 18 from an American company M&M. The amount was payable after 5 months, and the company entered into a contract on 1st January for 5 months. So this is clearly a contract to hedge this payment after 5 months at the rate 62.5 per dollar. So this is your forward rate. The exchange rate per dollar on 1st January was 60.75. This must be the spot rate. And then on 31st March 18, the rate is here. The rate is changing, but I don't have to worry. Let the rate be 63, let the rate be 68. I have to pay 62.5 ultimately. So this is irrelevant. You are required to state how the profit on the forward contract would be recognized in the books of Axe for 1718 as per AS11. So as per Axe, you will say that there was a forward deal which you have agreed at 62.5 against the spot rate which was at 60.75 on that date, and hence the forward premium that you are agreeing to pay is, I think, 1.75 per dollars for a total of $5 lakh, and hence if you multiply this, you will get 8,75,000. So this is your forward premium, but this 8,75,000 is to be recorded over 5 months. In the current year, 3 out of 5 months are done, and hence into 3 by 5, if you do, 5,25,000 is the expense to be recorded in the current year, and whatever is the remaining will be recorded in the next year. So if you go to see 5,25,000 in the current year and the remaining 3,50,000 to go in the next year. Next you go to question number 12. ABC is an Indian company obtaining a long-term loan from WW Private Limited, a US company, amounting to 30 lakhs. Same type of a question, question 2, question number, I think 6 or something. The loan was recorded at 60 rupees per dollar, and hence this will come to 30 lakhs divided by 60 comes to, I think, $50,000. Taking the exchange rate prevailing on the date of transaction, the exchange rate on the balance sheet date was 62, and hence there is a 2 rupee loss. I have to pay 2 rupees more. There is no repayment, etc. So you will say $50,000, which is your loan amount. So you will first convert everything into dollars, into rupees 62 that I have to pay by the end of the year, minus 60. And hence there must be a 1 lakh rupee loss. Sir, how is it a loss? I have to pay more. Instead of 60, I have to pay 62. And hence is a loss which will go to the P&L account ideally, unless you have decided to follow para 46A. But in this case, you have not been told that the loan is for a specific asset, and hence it is a general loan, in which case if you follow para 46A, it will go to the FCMI TDA. You are required to calculate the amount of exchange difference and also explain the accounting treatment as per AS11. So your exchange difference over here is 1 lakh rupees as we found, and we said this 1 lakh should be taken to the profit and loss account in case we don't opt for para 46A, or it will go to the FCMI TDA. So 1 lakh either in the PNL or in the FCMI TDA. Why? Because this is a long-term loan, and hence FCMI TDA option is available. Question number 13. Trade payables of CAT include, this is trade payable. So यहाँ पे 46A का कोई choice ही नहीं है. Gain or loss if any has to go to the P&L. Trade payables of CAT include amount payable to JBB of 10 lakhs recorded at the prevailing exchange rate on the date of the transaction, which is 80. So first you will always find the amount in dollars. That is the first step everywhere. You find the amount in dollars, which is 10 lakhs divided by 80 will probably come to 12,500. And this 12,500 would have been recorded at the rate of rupees 80, which came to 10 lakhs, that is your payable. The exchange rate on the balance sheet date was 85, so you have to pay more. For something which liability you have recorded as 80, you have to pay 85. You are required to calculate the amount of exchange difference and also explain the accounting treatment needed as per AS11 in the books of CAT Limited. So over here, you would say 12,500 into, in this case, rupees 85 per dollar minus rupees 80 per dollar, and hence this will come to, I think, rupees 72,500, which will be taken to the profit and loss account only. There is no FCMI TDA because it is a trade payable. 62,500, not 72,500. Just a second. This is what? 12,500 into 2.5. Sorry, 12,500 into 5 comes to 62,500, not 72,500. This is 62,500. Fair enough. To be taken to the profit and loss account. Debit the profit and loss. Okay, next is question number 14. This is similar to one, in fact exactly same. Kumar borrowed $3 lakh which will be repaid on 30th June. So this is a short term loan. Prepares finance statements on 31st March and the rate of exchange between the reporting date are as follows. So you have been given on 31st December, then March and then June. Calculate the borrowings in the reporting currency to be recognized in the books on the above mentioned dates and show the journal entries. So first you will have 3 lakhs into 44. 3 lakhs into 44 will come to 1 crore 32 lakhs. Then 44.5 per record karenge. So this is going to be 0.5 extra. So there is a loss of 1 lakh 50 and hence this will come to around 1 crore 33 lakh 50,000. So eventually you started at 44. It's 44 into 3 lakhs, 1 crore 32. Then 1 crore 3350. And there's a 1 lakh 50,000 loss which will go to the PNL account. So bank account debit to loan. Forex difference will go to the PNL account debit to loan. And then loan account debit you repay to bank. This is at the rate of 44.75. There's a further loss. Okay, second part says in case the borrowings were repaid on 20th February when the rate was 44.2, then it is the easiest. You don't have to remeasure anything. If they are repaid on February after passing the first entry for the loan at 44, that is at 1 crore 32 lakhs, you will repay the loan. Loan account debit 1 crore 32 to bank, 3 lakhs into 44.2, that is 1 crore 32 lakhs 60,000, and hence the balancing figure will be foreign exchange difference account which will go to the PNL account. Achha, question number 15, a basic question. Classify the following items as monetary, non-monetary. Like inventories, they are non-monetary. Money can be fixed, need not be fixed. I can sell the inventories, get more, less, I don't know. So it is non-monetary. Trade receivables is monetary, investment in equity shares is non-monetary, and PP is non-monetary. Okay, next you go to question number 16. This is a good question where you can practice what is to be done for para 46A. So here all permutations, combinations of para 46A are applied. A Limited has borrowed $10,000 in foreign currency on 1st April 11 at 5% per annum annual interest and acquired a depreciable asset. It is clearly given that you have borrowed this money to acquire an asset, but asset kitne ka hai wo nahi pata. The exchange rates are as under. On 1st April 2011, the rate was 48 and on 31st March 12, the rate is 51. You are required to pass the journal entries in the following cases. First, option under para 46A is not availed. Achha, what is the first journal entry when the loan is taken? On 1st April 11, when the loan is taken, your entry will be bank account debit to, let us say, Forex loan. How much, sir? $10,000 into rupees 48 per dollar. Exchange rate prevailing as on the date of the transaction, which means 4,80,000 you will record. Now, by the end of the year, you will have to pay interest. In this sum, interest is also there at the rate of 5%. So, this is $10,000 into 5% comes to $500. This is paid at the end of the year when the rate is 51. So, this is 25,500. It is interest, that is finance cost, which will go to the PNL account debit. Let us say to bank, this will be 25,500. This is $500 at the rate on the date when interest is paid, which is 51. So 4,80,000, 25,500. Now comes the third thing. Now loan, remember whether you take para 46A or you don't take para 46A, loan is a monetary item and hence it will have to be remeasured from 48 to 51 and hence there is a liability. This increases my liability by rupees 3 per dollar into, let us say, $10,000 and hence clearly there is a forex loss of 30,000 rupees. Now the problem is, where will the loss go? Well, liability has to be credited, but if para 46A is not taken, then the loss will go as foreign exchange difference to be taken in the profit and loss account. So this is loan credit, foreign exchange difference in the profit and loss account. However, in the second case, if option under para 46A is availed, so if the option under para 46A is availed, the loan will still be recorded at 4,80,000, interest will still be recorded 25,500. But when you remeasure the loan at the end of the year, instead of debiting the foreign exchange difference in the PL, think and tell me, what will you debit? बच्चे बोलेंगे FCMITDA. Wrong. You will debit a fixed asset over here, PP over here, because this is a loan for a specific fixed asset, for a depreciable asset, and hence in the second case you will debit the property, plant and equipment by 30,000. Okay. And the last part they are saying, point 3, if the loan was taken to finance the operations of the entity and not for procuring of depreciable assets, yes, then instead of debiting the PP account, if para 46A was taken, you would have debited the FCMITDA. So over here, if you highlight, in the last case, if you had then foreign currency monetary item transaction difference account 30,000. So long story short, when you take the loan, no difference. When you pay the interest, no difference. But when you remeasure the loan, if 46A option is not taken, you will always take it to the P&L account. If 46A option is taken, you have to see whether it is a general loan or a loan for a specific fixed asset. If it is a general loan, you take it in FCMITD. If it is for a specific fixed asset, adjust it along with the PP. Okay, so that is question number 16. Next we have question number 17. A company has imported raw materials worth $6 lakhs on 5th January when the exchange rate was 43 per dollar. So you must have passed entry purchase account debit to, let us say, bank if it is paid, or to payables, creditors if it is not paid, at the rate of 43. The company had recorded the transaction in the books at the above mentioned date, which is correct. The payment for the import transaction was to be made on 5th April 2022, which is after maybe 3 months, and as a result there will be a payable. You will have to remeasure this payable when the exchange rate was rupees 47 per dollar, but this is the exchange rate on 5th of April. However, on 31st March 2022, the exchange rate was 48 per dollar. Remember, the payables have to be remeasured at the exchange rate on the balance sheet date. So basically on 31st March, there would be a forex loss of rupees 48 per dollar minus rupees 43 per dollar, that is the rate on the date of transaction, for payables worth 6 lakhs, and hence there would be, I think, 48 minus 43 into 6 lakhs comes to 30 lakhs of forex loss. And where will this go? Sir, this will go in P&L. In what form? Sir, as forex loss. You are paying more, not because you are importing a superior quality material, but you are paying more because of the forex difference. So your purchase cost or cost of materials cannot be adjusted. It will be going to the P&L. The company passed an entry on 31st March 2022 adjusting the cost of materials. Now this is disastrous. Consumed for the difference between 47 and 43. There are two errors. First, you cannot adjust the cost of materials. You will have to adjust the forex loss. And second, on 31st March 23, the rate was not 47, it is 48. So you will take the difference between 48 and 43 and take it to the P&L. So your correct accounting treatment will be 30 lakhs will go to the P&L as forex loss. Your cost of materials will continue to be $6 lakh into 43 only. That will not be adjusted. Yes, in the coming year on 5th April, if you are actually paying 47, then there will be a 1 rupee gain which will go in the P&L in the next year. But that does not mean you record it today. It is not a adjusting event. You have to take the closing rate as a rate on the balance sheet date. So in the background, is the company's accounting treatment correct? The answer is no. There are two errors. First, adjusting cost of materials for the forex differences is wrong. Second, while calculating the gain or loss on 31st March 22, compare the closing rate on 31st March 22, that is 48 with 43, and get the answer. Okay, so this is 48 minus 43, that is the first thing. And second, it should be taken as exchange difference in the profit and loss account. Okay, question 18, it is a recent exam paper, but it is very similar to questions earlier done, and that is, I think, the last question. Jared Limited purchased a machine for $20,000 on 31st December 21, payable after 4 months. It entered into a forward contract for 4 months at 78.85. On 31st December 21, the exchange rate was 77.5. Now, this is a spot rate. You have to pay after 4 months, and this is for hedging, and hence, if you take the difference, we are agreeing to pay 78.85 for something which, when the payable was recorded, is worth 77.5, and hence you are agreeing to pay 1.35 more for $20,000, and hence $20,000 into 1.35 will possibly be 27,000, which is your premium, and this premium will be recorded over 4 months, out of which 3 months are in the current year, 1 month is in the next year. How will you recognize profit and forward profit for the year ended March? Into 3 by 4 if you do, you will get around 20,250, which will be recorded in the profit and loss account for the year 21-22. Trade payables of Jared include an amount to sterling of 975, which is recorded at the prevailing rate of 75. So this is 975 divided by 75. First step is always finding the dollar amount, which is $13,000. The exchange rate on the balance sheet date was 79, and the payment was made on 1st May when the exchange rate was 78.3. So when you recorded, the rate was 75, now it is becoming 79, so there is a 4 rupee loss, and hence 52,000 will be the loss. However, later you are paying at 78.3, and hence there is a 0.7 gain into 13,000, that is at 9,100 gain. So if I go to say 27,000, and 20,250 will be recorded in the year ended, and over here, when you look at the second sub part, there will be a 52,000 loss, and then there will be a profit of 9,100. So that kind of takes care of all the sums, including multiple sums for certain concepts where it is a little repetitive. So that takes care of AS11. I hope you are clear with the standard. Keep studying well, and I'll see you soon with another standard. Till then, keep studying. Good luck and goodbye. Study hard.